Purchasing Managers Index from a Standard Bank in Kenya pointed to a decline in business conditions in the second month of 2023, the first since August last year, as several key metrics fell into contraction territory. That's below the 50-point threshold. For the first time in 6 months, the headline PMI registered below the 50-point threshold in February, dropping to 46.6 from an 11-month high of 52 points in January. The reading indicated a deterioration in operating conditions driven by renewed contractions in many of the covered metrics. Still in Kenya, FIDA Investment Bank has published a report on the sustainability of Kenya's public debt. The report shows that December 2022, Kenya's public debt had risen to 9.2 trillion shillings, 71.7% of GDP. It was 88.6 trillion in June of last year, 18% jump from fiscal year 2020-2021. Now, the growth in public debt has been on an upward trajectory for the past 10 years, with annual growth rates above 9% and a 10-year compound annual growth rate of 18.3%, driven by an increase in external debt as a major source of funding. More headwinds for Kenya. Investor wealth at the Nairobi Securities Exchange as at Monday plunged to a 6-year low after signals of a rate hike in the U.S. prompted foreign investors to sell off blue chip stocks. Market capitalization, the value of stocks at the Nairobi Bourse dipped to 1.7 trillion shillings, lowest level since March 2017. The NSE has since last week, Wednesday, shed about 135 billion shillings, with a number of blue chip stocks resulting in 98% of that fall: Safaricom, EABL, Equity, and KCB Group. All right, let's talk to Erick Mokaya, who, of course, is the founder of Mwango Capital. Erick, good morning to you. Thank you so much for joining us. I want to start with the markets. 6-year low. Can we attribute this all to rate hikes in the United States, Erick?
I don't think so. I think it could be just also that we're having challenges a bit with the forex rates. So I think there's a bit of supply-demand gap in the market, which is driving up the forex rates upward. So I think the Kenya shilling itself is up around 5% this year. It was down. It was against the dollar. So I think that alone means that any investor who's foreign, who's in the country, needs to beat returns of around 5% plus, and that's really hard to get in this market. So I think that's part of the reason why, especially foreign investors, are exiting the market. And one of the stocks that are exiting the market the most is Safaricom, and Safaricom is the biggest company at the NSE, accounting for around 60 to 70% of market cap. So when that drops, definitely there will be a drop in the NXT market capitalization. So I think it's just worries around foreign. Worries especially around the forex rates, and then also worries around what the new regime has in terms of plans for the economy. If you look at lending to the government, it's more on the short end. On the long end, people are a bit skeptical. They just want to take a wait and see approach and see some of the issues how the new administration, which has been around for around 6 months now, is going to work out some of the things that they promised they would do. So I think it's more of a wait-and-see approach from most investors and foreign investors exiting the market that's actually putting pressure on the market capitalization.
Thanks,
that would be my take on it.
Great stuff, great stuff. I want to move to the Standard Bank Kenya Purchasing Managers Index. Are you concerned by the drop in business activity in Kenya for February? 46.6 points.
Again, it's not much of a concern. It's something that has been lingering for a while. Again, it's more to do with the way people are approaching the new regime, so a bit cautious. There are issues to do with people are waiting to see a lot on what the government does in terms of taxes. There's promise to raise taxes in certain pockets of the market. So I think that's causing a bit of caution on the investment front for most manufacturers and investors that we're talking to. So I guess that could be one of the reasons why the PMI is doing a bit badly. I wouldn't read too much into that, but that would be my take on that.
What about the debts? We've seen this report from FIDA Investment Bank. Public debt, 9.2 trillion, 71% of GDP. I mean, William Ruto just coming into office, does he have his hands full in terms of bringing those figures down? Are you concerned about that number?
I think debt is one of the biggest concerns because next year we have a $2 billion we need to pay back in terms of Eurobond debt. I think that's going to be a substantial outflow that we have to be really planning for. The government is trying to plan on how to do that. Maybe raise another Eurobond. And if you're going back to the market to raise a Eurobond, you're raising at around 10+%, which is not good for you long term. So I think that's a big challenge for the government, the sustainability of the debt. I mean, when they came into power, they said that they inherited very empty coffers. So I bet they need to raise a bit of money to sustain themselves as a government. And I mean, that $1 billion that is supposed to come from the World Bank in the next financial year will be very helpful towards repaying some of the debt and maybe helping a bit ease some of the foreign exchange issues that we're having. Last I checked, our foreign reserves and our import cover has dropped below the four-month cover that is usually required by law. And now we're around 3.67, which is not good generally. So I think that's a worry. Mix the debt and the forex issues, and you have a real concern in our hands.
Thanks, Eric. Final question. I think you already preempted it, because I think you mentioned it just a moment ago. The $1 billion from the World Bank that it's on its way to Kenya, you're saying that should help a bit?
That will help definitely a bit in the sense of, like, as I said, we have the import cover that has dropped around to below the 4-month cover, which the CBK really requires, or at least aims to meet. So I think below that, then that means there's a lot of pressure in terms of the shilling. The shilling is now trading at around, I think this morning I checked, around 129. If you check the regulator, EPRA, who prices oil, they're pricing the shilling at around 134. That's 5 shillings above where this official CBK rate is on itself. In the market, you get the dollars at around 140. So I think huge pressures on the shilling, and currently we're really trying to make sure that we don't have more in terms of imports that need us to pay more in dollars. So I think the government also this week has entered into an agreement with the Saudi Aramco and Abu Dhabi so that they can be able to get a bit of credit on oil, 6-month credit, which can ease a bit of the pressure that they see in terms of 0.5 billion is supposed to flow out of the market every month to pay for oil. So I think we are really trying to make sure that the shilling does not hit something like 150, which is really bad for the market. So I think, like, lots of pressure in the market, lots of supply demand gaps, and hopefully that $1 billion will do us some good. We need more money to flow into the market as much as we can.
Erick Mokaya, founder of Mango Capital. Erick, thank you so much for your time. Really.